Retired service members can optimize their military retirement pay by strategically choosing states with favorable tax policies. While federal taxation is unavoidable on military retirement income, the silver lining lies in the fact that most states fully exempt such income from state taxes. However, not all states are equally favorable to retired military members. Some impose partial tax breaks, or in certain cases, no exemptions at all. To avoid a state tax bill, retirees may want to steer clear of specific states mentioned in this video. Number 1. California. Top on the list is California, widely recognized for its high tax rates. Among all states in the U.S., California stands out as the most expensive for military retirees due to its unique policy of fully taxing military retirement pay. Despite recent deliberations by state lawmakers to potentially eliminate this tax on California military pensions, the bill's consideration has been postponed and is slated for review in the coming year. Moreover, California has the authority to impose a 2.5% state penalty on early distributions from retirement plans, annuities, and IRAs, in addition to the 10% federal penalty for early withdrawals. It's worth noting that Tier 1 railroad benefits and Social Security benefits remain exempt from state taxation in California. Number 2. Oregon. Oregon extends a full exemption on military retirement pay for certain retirees, specifically those with service credits earned before October 1991. However, the 100% exemption is exclusively available to veterans falling under this specific category. Retirees who served both before and after the mentioned date qualify for a partial income exclusion. Notably, railroad retirement and Social Security benefits are granted tax exemption in the state. Number 3. Delaware. Delaware imposes taxes on military retirement pay and provides a limited income exclusion of up to $12,500. Notably, military disability retirement pay disbursed to veterans and their families remains untaxed by the state. Delaware's income tax rates peak at 6.6%, and it's worth mentioning that the city of Wilmington enforces a separate income tax. The pension exclusion, capped at $12,500, maximum exclusion for all income, isn't exclusive to military retirement, but also applies to various forms of retirement income for taxpayers aged 60 and older. This encompasses income from dividends, rentals, and interest. Additionally, the state exempts Social Security and railroad retirement benefits from taxation. Number 4. Georgia. Georgia stands out with a more generous exclusion for military retirement pay compared to Delaware. In this state, taxpayers are eligible to exclude $17,500 from their taxable income, and this exclusion extends to their spouses, provided they meet the qualifying criteria. For some married veterans, this translates to a substantial deduction of $35,000 from their Georgia taxable income. Adding to this favorable scenario, Georgia permits an additional $17,500 subtraction for individuals who receive more than $17,500 in earned income during the tax year. This provision brings further good news for certain veterans. It's important to note that these retirement income exclusions are applicable to taxpayers aged 62 and older in Georgia. Number 5. Montana. A recently enacted law in Montana introduces a beneficial change for veterans, allowing them to exclude up to half of their military retirement pay from their state taxable income. This law takes effect on January 1st, applying to tax years 2024 and onwards. For the year 2023, taxable income at the state level incurs a tax rate ranging from 1% to 6.75%. However, starting in 2024, the tax rates for taxable income will shift to fall between 4.7% and 6.5%. Notably, railroad retirement benefits enjoy tax exemption in Montana, while the state taxes Social Security benefits unless the recipient's income falls below the set threshold for the respective year. Number 6. Vermont. In Vermont, certain retirees are eligible for a military retirement income exclusion, albeit with income limits, and the exclusion is capped at a modest $10,000. Adding to the less than generous aspect, Vermont residents face a restriction. They cannot simultaneously claim both the military retirement exclusion and the Social Security income exclusion. Unfortunately, this limitation is one of several factors contributing to Vermont's unfavorable tax environment for retirees. For those not meeting income requirements, Social Security benefits are taxable in the state, contrasting with the tax exemption granted to railroad retirement benefits. Number 7. Virginia. Thanks to a recent budget deal, Virginia is set to progressively raise its military retirement income exclusion in the coming years. For the tax year 2023, the exclusion stands at $20,000, but this figure is slated to rise to $30,000 in 2024 and further increase to $40,000 for tax years 2025 and beyond. Initially limited to taxpayers age 55 and older for the 2023 2023 tax year, the age requirement for this exclusion will be eliminated starting in 2024. In addition to these positive changes, Virginia provides tax exemption for Social Security benefits and railroad retirement benefits, offering further financial relief for retirees in the state. Number 8, New Mexico. While New Mexico is gradually becoming more affordable for retired military members, it still ranks as more expensive than the majority of states in the United States. In 2023, veterans have the option to exclude $20,000 from their taxable income. Looking ahead, this exclusion will see an increase to $30,000 for the tax years 2024 through 2026. Notably, taxpayers aged 100 and older are entirely exempt from paying New Mexico income tax, providing a unique benefit for centenarian residents. Number 9, Idaho. In Idaho, the pension exclusion isn't universally applicable, and this includes veterans receiving military retirement benefits. Eligibility for the exclusion is contingent upon being 65 years or older, or 62 years or older if the individual has a disability. Only at this age threshold can retirees subtract their pension income from their Idaho taxable income. The maximum exclusion amount for the year 2023 is set at $41,140, subject to annual recalculations by the state. Number 10, District of Columbia. While not a state, Washington, D.C. stands out as one of the most costly places in the U.S. for retired veterans. Similar to California, the District of Columbia imposes full taxation on military retirement pay. Adding to the financial challenges, some residents may face tax rates as high as 10.75%, exacerbating the burden for retired veterans living in the nation's capital. Number 11, Maryland. Maryland has recently made adjustments to its income exclusion for retired military members, yet it remains comparatively less generous than similar provisions in other states taxing this category of income. For retirees aged 55 and above, a deduction of up to $20,000 from their taxable income is applicable, while those under 55 are eligible for a reduced amount of $12,500. Additionally, retirees aged 65 and older, along with those with total disabilities or spouses with total disabilities, can benefit from a pension exclusion of up to $34,300, providing an additional avenue for financial relief in Maryland. Number 12, Colorado. In Colorado, veterans are granted the opportunity to exempt a portion of their military retirement pay from state income tax, with the eligible amount contingent on their age at the conclusion of the tax year. For the year 2023, retired service members under the age of 55 can deduct $15,000 from their taxable income. Meanwhile, retirees aged 55 and above have the option to claim the standard Colorado pension and annuity subtraction, which amounts to $20,000 for individuals up to age 64 and increases to $24,000 for taxpayers age 65 and older. Number 13, Kentucky. Kentucky offers a retirement income exclusion with a maximum limit of $31,110. For military retirees whose federal pension surpasses this amount, there is a possibility of qualifying for an even higher exclusion. Notably, retirement income associated with service credits earned before 1998 enjoys a 100% tax exemption. Retirees with service credits acquired in 1998 and beyond can utilize the worksheet on Kentucky Schedule P to ascertain the taxable portion of their retirement pension. Furthermore, the retirement income exclusion, capped at $31,150, extends to distributions from 401k and IRAs, providing a comprehensive benefit for qualifying individuals in Kentucky.